welcome to the Think Generational Wealth podcast. I think this is episode number 106. I am your host, Amir Estimo. I appreciate you taking the time to listen to this podcast episode today because you could be doing anything, and I mean anything in this world. But the fact that you're taking the time to listen to this podcast, I hope this podcast is of value to you. So, I would like to say I appreciate anybody that takes the time. Also, I would like to welcome any new listeners to the Think Generational Wealth podcast episode. Okay? So let's go ahead and dive into the podcast episode later on. I will share my social media contact information if you'd like to. It's something I'm still trying to work on is getting more active on social media. But I think a platform that I've taken a liking to lately is TikTok. And we all know what's going on with TikTok. TikTok baby banned. So until then, you can always follow me on Think Wealth Gym at TikTok. Or you can check me out on my soon-to-be YouTube channel at Think Wealth Land. Okay? So let's dive in to the podcast episode. So today's podcast episode is we're going to dive in and talk a little bit. It's going to be probably a relatively short episode. We're going to focus on home equity line of credit versus home equity credit. So I don't know if you guys are aware, but the home equity line of credit is called a HELOC. And then you have your home equity credit. Or let me make sure I get this right. Or we have the home equity loan. So those are the two. HEL and HELOC. So what's the difference between the two? Okay. So the HELOC it's called home equity line of credit. The home equity line of credit, basically what it does is it gives you a chance to tap into your equity. So most of the time, people don't tap into their equity until they sell the home. But what a HELOC does is a HELOC allows you to tap into that equity of your home early. Now, how does this work? Well, let's say, for instance, you have a home. The value of the home is $300,000. And let's say 200,000 just to kind of make it a little bit easier. Let's say you had 200,000 and you owed 100,000 on your mortgage. So that means you have $100,000 equity in your home. But what most states, I know in the state of Texas, they allow you to borrow up to 80%. So that means you can only borrow $80,000 of that loan, of the equity. Now, once that happens, you can go to a local bank. Bank of America does it. Chase does not do it. The last time I checked, they don't do home equity line of credit or home equity loan. So Chase does not. But Bank of America does, or you can just go to a small credit. You can go to a credit union or even a small bank, a local bank in your area. It's probably best to probably go to a local bank in your area or credit union because there's certain advantages you will have with that. Versus if you were to go to like a Bank of America or a big name bank, Wells Fargo or something to that nature. Now you can borrow up to 80%. You have $80,000 you can borrow. Now, with the home equity, the HELOC, what the HELOC does then is the advantage of the HELOC is you can tap into that equity a lot earlier. So if you wanted to, for say, example, maybe pay off some bills, or you wanted to do some renovations in your home, or, for whatever that reason you wanted to tap into your equity, you would be able to do it a lot earlier. The disadvantage of that is you got to be careful with the fees, closing costs. So if you go and borrow you go into your equity, you tap into your equity early, you got to be cognizant of the fees. Some companies or some banks will charge you closing costs. Some banks will even charge you an annual fee if you tap into that equity early. But the advantage of it again is that you get to basically have it's like a line of credit open. So whatever you take, you got to pay interest. And for the first 5 years, you are paying interest only payments. So that means whatever you pay does not go into principal. But a good thing too, again, is let's say you want to even start a business, you could be able to tap into your home equity, and then you can be able to start your business. And let's say you start your business start doing well. Now you can put that money back into the equity, into the HELOC, and then use it again. So it's basically you have a 5 year window. You can do as many draws as possible, depending on your circumstance. But what you want to also be careful is with the home equity line of credit is that the rate is based off with the feds. So if the feds raise the rates, or the Wall Street Journal, or not the Wall Street Journal, but the Fed raised the rates, it goes up, it can go down. So for give you a prime example, in January, me and my wife checked, we were looking into this, and the interest rate at the time was 6.25%. Now it's 8%. And sometimes it goes up, 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 and sometimes it goes down, down, down. So it's a variable rate. It's not a fixed rate. Okay. So you want to keep that in mind is if you decide to do this, go this route, what you want to make sure is you are very, very, I would say, analyze your financial situation first. Because what you're doing is you're giving up your house as a collateral in return to tap into that equity. So if you, let's say, for example, you borrow exuberant amount of money and you can't pay it, they can just come around, whoever the bank is can come around and close and foreclose on your property. Now, if you have a mortgage, they will take second position, not first. It just depends. I've even heard, I actually was just talking to a banker recently when we've looked into this. And you asked me, okay, Amir, why would you do it? Well, the reason why I'm doing that is because I don't know if you guys know, I am in the land business. And what that does, it lets me access. So if I want to fund my own deals, then I can just tap into that equity, fund my deal, close on whatever I'm doing. And let's say if I turn around and sell that property, I can just actually just take that money and put it right back into the line of credit again, a home equity. So this is not something I'm doing to where I'm taking it and paying bills, or taking it and going on a trip, or taking it doing foolishness stuff that doesn't make any sense. I'm just doing this because I want to be able to have another way to fund my business. Okay. So what you really want to understand is, folks, is you do not want to go in, even if you have $80,000, you don't want to go in there and tap into all that money at once. Because again, if you don't keep up with the payments and the interest rate goes up every quarter, and if you don't pay, they can foreclose on your property. So that is a huge risk you're taking if you go in there and you just take a whole bunch of exuberant amount of money. And this was something at first, I'll be candid with you guys. I was actually thinking about it. I said, okay, you know what? The startup cost for my business has been pricey. But when I really thought about it, I said, is this going to be worth me going and taking all this money? Is this going to be worth it? Because you never know your circumstance, because your circumstance can change at any time. So you want to make sure you are 100% certain. If I'm going to tap into this equity and I got to keep up with the payments, I don't know how much your payments are going to be. I don't even know how much my payments are yet. But again, I have not even tapped into it because I'm keeping it open, because this is something I'm using to fund deals and then put the money right back. So this is a transactional thing. So I don't want every time, I don't want to go and borrow an exuberant amount of money and then you can't pay it back because for whatever reason you just can't pay it back, and now you're losing your home. So you want to be careful with that if you're going to do the home equity line of credit. Okay. Now you have your home equity loan. Okay. So the difference between that one is this one is basically a fixed rate. This is an unsecured loan. So meaning the interest rate is higher on this too. So it goes anywhere between, I don't know exactly, but I remember back in January when we were thinking about this, it was 11%. Okay. And this is fixed interest. So which means that if you have your 80,000, you say, well, I don't think I'm going to need that much money. Let's say 30. I'm just going to take 30,000. Well, guess what? You can only take $30,000. Then you cannot go back and take any more. And if you decide to do that, then first of all, you would have to not only just pay the loan off, number one, and number two, you would have to apply for another home equity, a home equity, and and I don't think you can have two of those open at a time. I'm not 100% sure, but that's something that you can confirm if that's what you decide to do. But again, the home equity loan is a fixed, and if you go in there and say I need $30,000, that's what you're going to go get. You will not be able to go get any more money. So those are the differences between the two, and the interest rate is a little bit higher on the home equity loan versus the home equity line of credit. Okay. So again, I'm first of all, I like to say I'm not a financial advisor. So this is all for educational purposes. Okay, folks. So please, please think your financial situation very thoroughly. I'm not advocating for you to do this because the reason why I'm saying, because if you're trying to build wealth, right? Why would you do that by tapping into your home equity loan or your home equity, right? But if let's say you want to start a business, that's something you want to consider, okay? Or let's say maybe you want to buy a rental property. You can do something like this. This will be probably something you can do, okay? Then you have the cash out refi. All that is that you're paying off your old loan with the new loan. And sometimes if you don't put, let's say, the closing cost, it allows you then to take some of your equity out. So if you wanted, for example, I want to take $20,000 out on a cash out refi, you would refinance. So you would probably go for a lower interest rate. But then let's say you needed $20,000. Now that $80,000 turns into $60,000. So now you got a new loan, a new interest rate, and you have less equity. But on a cash out refi, generally you're paying closing costs. And if you don't pay the closing costs up front, it gets rolled into your new loan. So I've done a cash out refi. It's not something that I would probably do again, but just because of the fact that if every time you refinance your house, your mortgage is going to go up a little bit. Okay, so you want to keep that in mind. If it does, it does. If it does not, depending on your situation, you want to make sure you talk to whoever, a banker, etc., to make sure you're doing this correctly. Okay, so I just wanted to share this with you guys today. Again, I'm not advocating for anyone to just go and get into some financial mess because that's not what this podcast is about. If we're trying to build wealth, we got to do it the right way. Okay, folks. But I'm just saying, you want to make sure you are wise. You are very wise with doing this because you can end up losing your home if you do not keep up with these payments. Now, another thing with the home equity line of credit, not the home equity loan, the line of credit is you want to make sure also too that whoever you decide, if you decide to go this route, that they take care of the closing costs or there's no fees, hidden fees or fees. Like if, let's say if you were to take money out and then you get charged an annual fee for taking money out. So you want to make sure you educate yourself, ask the right questions before you do anything of this nature, because I do not, and I repeat, I am not advocating for anyone to lose their home. The only reason I'm saying this is do not go and take money out to pay off debt. Now, you could if you want, but the reason I'm saying is you're taking equity out of your home to go pay debt. And if your debt is a lot, it's probably best, depending on what you have, it's probably best you reevaluate your financial situation. Because that's probably because even if you go this route, you're going to come back to the same, you're going to come back to the same point again if you didn't learn from the beginning. So a lot of people go and do this, and then they end up in debt, and then they don't know why. Well, it's because you didn't learn from the get go. So again, if this is something you were to consider, and it's you want to make sure that you are completely understand what you're getting yourself into, and do not go take money out to go pay off other debt. Now, maybe a credit card balance of $5,000, that's probably worth it, right? Because of the fact that you're getting 8% or 6.25% versus a credit card where you're paying up anywhere to 20 to 25% interest rate, which could take you even much longer. So the process would be they would run your credit, and there's all this other documents you'd have to provide. But again, you want to make sure, do you know what is the reason why you're doing this? Is it to start a business? Is it to buy more properties? Is it to maybe pay off a small debt, do renovations in your home? Those would be probably the most ideal situation. But do not go take money out. If you were to go to the fixed rate or variable rate, do not go take money out just to take money out and then still be in debt. That's not wise at all. Okay. So I hope you guys learned from this, and you guys got some value out of this. I know this is a very short episode because, again, HELOC it's a very straightforward topic. You have variable rate interest, fixed rate. Hey, I can tap into my equity. Here's a process, and you guys can decide which way you want to go. Okay, but again, I would not advocate. I've said this multiple times, and the reason I'm saying this is I would hate for anyone to go this route and then all suddenly, bam, they're in big trouble. Okay, so I appreciate you taking the time, and until next week, much love to you guys. Again, you can follow me. I'm going to be on TikTok. I'm going to post a little bit more on TikTok. I'm trying to get more active on social media, but sometimes for me, it's social media is something. It feels like it's too much at times. But I started to narrow it down to platforms. Like I've been looking at TikTok, seeing a different type of content on TikTok, and I like TikTok. I haven't been on Facebook active. I'm on Facebook generally. I just go around groups. I'm in different groups, and that's the only time I'm really on Facebook. I don't really post much on there. And then on Instagram is something I don't really post much on either. But so that's why I don't really share too many of my contact information on social media, LinkedIn, etc. It just feels like it's a lot. And sometimes with me, it's just I'm always on the go. So it's like social media. Like I like to have some type of privacy. Okay. All right, folks. I appreciate you guys taking the time to listen to this episode. Until then, much love. See you next week. Peace.